Welcome to Greatness, where we help you elevate your story. Today we're delving into a topic that's often overlooked, yet incredibly crucial, especially for our young adults out there. We're going to explore the 5 common money mistakes you definitely want to avoid in your 20s and 30s. Financial literacy is not just about understanding numbers. It's about making informed and effective decisions with your financial resources. It's about understanding that every purchase, every investment, every financial commitment you make today impacts your future. It's about realizing that the financial decisions you make today will shape the life you lead tomorrow. We'll be unpacking these common pitfalls, shedding light on why they can be detrimental, and offering you practical tips on how to avoid them. Because remember, it's never too early to start making smart money moves. Are you ready to take control of your financial future? Let us know in the comments below. First on the list of money mistakes is not saving for retirement. Now you might be thinking, retirement? But I've only just started working. And indeed, retirement may seem like a distant event on the horizon of your life. But it's precisely because retirement is so far away that saving for it now is so crucial. Let's start by talking about compound interest. Picture this. You're planting a seed. The seed may be small, but given time, sunlight and water, it grows into a robust tree. That's how compound interest works. The money you put into your retirement fund is the seed. The interest it earns over time is the sunlight and water that helps it grow. The longer your money has to grow, the larger your retirement fund becomes. And the beauty of compound interest is that it grows exponentially. The interest you earn this year will earn its own interest next year, and so on. Next, let's talk about employer-matched retirement funds. If you're fortunate enough to work for a company that offers this benefit, it's like getting free money. Your employer will match a certain percentage of the money you contribute to your retirement fund. It's a win-win situation. You're saving for your future, and your employer is essentially paying you to do so. However, not everyone is lucky enough to have employer-matched retirement funds. If you're one of those people, don't despair. There are other ways to save for retirement. Individual retirement accounts, or IRAs, are a great option. They offer tax benefits that can help your retirement savings grow more quickly. But the key takeaway here is this: start saving for retirement as early as you can. Even if you can only afford to put away a small amount each month, it's better than nothing. The power of compound interest, combined with time, can turn small contributions into a substantial nest egg. So don't make the mistake of putting off saving for retirement. The earlier you start, the more time your money has to grow. And the more money you'll have when you're ready to kick back and enjoy your golden years. Remember, the earlier you start saving for retirement, the better off you'll be in the long run. The second money mistake is living beyond your means. Now, what exactly does it mean to live beyond your means? In simple terms, it refers to a situation when your outgoings, that is, your expenses, are more than your income. You're spending more than you're earning. Picture this. You earn £1,000 a month, but you're spending £1,200. That extra £200? That's living beyond your means. And where is that extra £200 coming from? More often than not, it's borrowed money, which is a dangerous game to play. You see, when you're living beyond your means, it's very easy to accumulate debt. Credit cards, loans, overdrafts, they might seem like a quick fix to your financial woes, but in the long run, they only serve to dig a deeper hole. Interest piles up, your debt grows, and before you know it, you're in over your head. So, how do you avoid this? The answer is simple: live within a budget. A budget is a plan for your money, a roadmap that guides your spending and saving. It helps you allocate funds for your needs, like rent and groceries, and also for your wants, like that new pair of shoes or that holiday trip. But remember, the key is balance. Your needs should always take priority over your wants, and your spending should never exceed your income. Living within your means doesn't mean you can't enjoy life. It doesn't mean you have to give up on your dreams. It simply means being smart about your money. It means understanding the difference between what you need and what you want. It means knowing how to prioritize your spending. It means making the hard decisions today so that you can enjoy a financially secure tomorrow. So keep your expenses under control and live within your means. It's not always easy. It takes discipline. It takes sacrifice. But trust me, it's worth it, because the peace of mind that comes from financial stability, there's no price tag for that. Third on our list is not having an emergency fund. An emergency fund is your financial safety net for when life happens. And believe me, life will happen. It could be a sudden job loss, a car breakdown, a medical emergency, or even a global pandemic. Without an emergency fund, these unexpected events can lead to financial stress or even debt. So, how much should you save in your emergency fund? A general rule of thumb is to save enough to cover 3 to 6 months of living expenses. This includes rent or mortgage, food, utilities, transportation, and any other necessities. However, the amount can vary depending on your personal situation. If you have a stable job or multiple sources of income, 3 months of expenses might be enough. On the other hand, if your income is irregular or you have dependents, you might want to aim for a larger safety net. Now you might be wondering where to keep your emergency fund. It should be easily accessible, but not too accessible that you might be tempted to dip into it for non-emergencies. A high-yield savings account is a good option because it allows your money to earn interest while it's waiting for a rainy day. Let's be honest, saving for an emergency fund may not be as exciting as saving for a vacation or a new car. But think of it this way: you're investing in your peace of mind. With an emergency fund, you can sleep better at night, knowing that you're prepared for whatever life throws at you. And remember, it's never too early or too late to start building your emergency fund. Even if you can only save a small amount each month, it can add up over time. Before we wrap up, here's a quick tip. Treat your emergency fund as a bill. Set up automatic transfers to your savings account each month. That way, you're paying yourself first before you spend money on other things. Don't wait for a rainy day to start saving for it. Start now. The fourth money mistake is neglecting insurance. Now let's pause a moment here. You may be thinking, insurance? That's something my parents worry about. But here's the thing. Insurance is not just for the older generation. It's a financial safety net that everyone, including young adults, should consider. Let's start with the basics. What is insurance? Simply put, it's a contract, a policy, in which you pay a certain amount, known as a premium, in exchange for a promise from the insurance company that they'll cover specific losses, damages, illnesses, or deaths. It's like having a safety net, ready to catch you when life throws a curveball your way. There are different types of insurance that young adults should consider. First up, health insurance. No one plans to get sick or hurt, but most people need medical care at some point. Health insurance covers these costs and offers many other important benefits. It's a must-have, especially in a world where medical costs can quickly escalate. Next, we have car insurance. If you own a car, this one's a non-negotiable. It's not just about covering the costs if you have an accident, though that's a big part of it. It can also protect you from financial liability if you're at fault in an accident that causes injuries or property damage. Then there's renters or homeowners insurance. If you're renting, your landlord's insurance won't cover your personal belongings. A renter's insurance policy can protect you from the cost of replacing your stuff if it's damaged by a fire, theft, or other covered event. And if you own your home, homeowner's insurance can protect your property and belongings, plus it can provide liability coverage. Insurance might seem like a big, unnecessary expense when you're young and healthy and your car and home seem indestructible. But remember, insurance is about managing risks. It's about ensuring that if something does go wrong, you're not left in a financial hole that takes years to climb out of. Insurance might seem like an unnecessary expense now, but it can save you from financial disaster in the future. Last but not least, the fifth money mistake is ignoring your credit score. Now, many of us underestimate or even ignore the importance of a good credit score, often brushing it off as something only banks and lenders care about. But here's the reality check you need. Your credit score matters. It's like your financial fingerprint, a snapshot of your financial health that follows you wherever you go. So what is a credit score? It's a 3-digit number that signifies the risk a lender takes when you borrow money. It's determined by your credit history, which includes your payment history, amounts owed, length of credit history, types of credit used, and new credit. Here's why you should care. A good credit score can open doors for you. It can help you qualify for loans, secure lower interest rates, and even impact your ability to rent a home or land a job. In essence, a good credit score is your ticket to financial opportunities. But how do you improve it? First, always pay your bills on time. Late payments can significantly harm your score. Second, keep your credit utilization low. That's the ratio of your credit card balances to your credit limits. It's generally suggested to keep it under 30%. Third, diversify your credit. Having a mix of credit types like credit cards, a car loan, or a mortgage can boost your score. Lastly, don't open too many new credit accounts in a short period. This can make you seem risky to lenders and negatively impact your score. And remember, checking your credit score regularly won't hurt your score. It's a myth. In fact, regular checks can help you spot any errors or signs of fraud. So, don't ignore your credit score. Nurture it, improve it, and let it open doors for you. It's not just a number, it's a reflection of your financial responsibility and reliability. Remember, your credit score is like a financial report card, and you want it to be as high as possible. Let's quickly recap the 5 money mistakes to avoid in your 20s and 30s. We began by discussing the importance of saving for retirement. It might seem far away now, but the earlier you start, the more time your money has to grow. Remember, the power of compounding is on your side when you start early. Next, we addressed the pitfall of living beyond your means. It's easy to get caught up in a lifestyle that isn't sustainable with your current income. The key takeaway here is to create a budget and stick to it. Living within your means doesn't mean you can't enjoy life. It simply means making smart choices about your spending. Our third point was about the importance of having an emergency fund. Life is unpredictable, and having a safety net can save you from financial distress when unexpected costs arise. Aim to have at least 3 to 6 months' worth of living expenses saved up. Fourthly, we highlighted the often overlooked aspect of financial planning: insurance. Whether it's health, life, or property insurance, it's vital to protect yourself and your assets from unforeseen circumstances. Insurance isn't just about preparing for the worst, it's about ensuring the best for your future. Lastly, we discussed the impact of ignoring your credit score. Your credit score is like your financial report card, and it can affect many aspects of your life, from getting a loan to securing a rental agreement. Regularly checking your credit score and working to improve it can open doors to better financial opportunities. Remember, it's never too late to start making smart financial decisions. These 5 points are not just mistakes to avoid, but stepping stones towards a secure and prosperous future. Financial literacy isn't a destination, it's a journey. And every step you take towards understanding and managing your money is a step towards financial independence. Thanks for joining us today on Greatness. Be sure to like, share, and subscribe for more tips on elevating your story. Before we wrap up, we have a little homework for you. Yes, you heard it right, homework. But this is not your average school assignment. This is about you taking control of your financial future. Start by taking a moment to review your current financial habits. Are you saving for retirement? Living within your means? Maintaining an emergency fund? Keeping up with insurance policies? Paying attention to your credit score? If you've identified areas where you're lacking, don't dismay. It's never too late to make changes. Remember, financial success is not about perfection. It's about progress. Each step you take towards better money management is a step towards a more secure future. Maybe you've been neglecting to save for retirement, or perhaps you've been living a little too lavishly. It could be that you've ignored the importance of an emergency fund, or maybe you've been overlooking your insurance needs. Or perhaps you've been oblivious to your credit score. Whatever the case may be, know that it's never too late to make a change. Your homework is to identify one area where you can improve and take action. Even a small step, like setting up a monthly savings plan or cutting back on unnecessary expenses, can make a huge difference in the long run. We'd love to hear your thoughts on this. What are some other money mistakes that you think should be avoided? What steps are you taking to improve your financial habits? Your insights might just be the inspiration someone else needs to take their first step towards financial greatness. So, go ahead and drop a comment below. Let's make this a space where we can learn from each other and grow together. Remember, your journey to financial greatness starts with you. Like, share, and subscribe to stay on the path to success. Until next time, keep elevating your story.